All right, let's dive right in. Today, we are tackling one of the biggest questions in finance. How do you actually pick a stock? We're going to break it down with a clear step-by-step guide to help you navigate this really complex world with a lot more confidence. So let's get to it.
I mean, it's a huge question, right? You look at the market and it is just vast. The number of choices can feel, well, completely overwhelming. But don't worry. Think of this explainer as your map and your compass to start finding your way.
So here's our game plan. We'll start with the personal side of things, the stock picking challenge, and figuring out your own investing style. Then we'll zoom in on the market, looking at the two main ways to analyze a stock, how to find a company's true value, and the different ways you can actually invest. And we'll wrap up with what might be the most critical piece of the whole puzzle, mastering risk and your own emotions.
Okay, first things first, there is no single best stock. There's no perfect strategy that works for everyone. The whole process really has to begin with you. It's all about building a personal framework that actually fits your life and your goals.
So you've got to ask yourself some honest questions. What are you actually trying to achieve here? Are you saving for retirement way down the road, or maybe a down payment in a few years? How do you really feel about risk? And be realistic. How much time and money can you actually dedicate to this? The answers here are going to shape every single decision you make from this point on.
So once you've done a little of that soul searching, it's time to create your personal rulebook. This is your trading plan. Heading into the market without a plan is kind of like setting sail without a destination. You're just going to drift around.
A really solid plan has three key parts. First, you need SMART goals. That's specific, measurable, attainable, relevant, and time-bound. It makes your goals concrete, not just vague wishes. Second, pick a trading style that actually fits your personality and your schedule. And third, and this one is absolutely non-negotiable, you have to define your risk rules. Know exactly how much you're willing to lose before you ever click buy. So what's it going to be? Are you the tortoise or the hare? A position trader is the tortoise, right? Holding stocks for months, maybe even years. Or maybe you prefer the short-term game. Swing traders are in and out over days or weeks. Day traders do it all within a single day. And then you have scalpers, who are making moves in just minutes or even seconds. Your choice here really comes down to your personality and how much time you can commit.
All right, you've got a plan. Now, how do you actually analyze a stock? Well, there are two main schools of thought, and a great way to think about them is as the detective versus the market meteorologist.
And the difference between these two is pretty striking. The detective, who uses fundamental analysis, digs deep into a company's health. We're talking financials, leadership, the whole economy, to find its true underlying value. The meteorologist, using technical analysis, pretty much ignores all of that. They just study the price charts and market trends, trying to forecast where the price is headed next.
So let's put on our detective hats for a minute and dive a little deeper into fundamental analysis. The core question we're trying to answer here is simple. What is this company actually worth, and is its current stock price fair?
Part of this investigation is about the story, the qualitative stuff. Is the company in the news for good reasons? Did they just bring in a visionary new CEO? What's happening in the wider economy? All these narrative threads can have a massive impact on a stock's price.
And all of this detective work leads to this central idea of intrinsic value. This is the value you calculate based on your research. The core belief here is that even if the market price seems a little crazy today, sooner or later it will eventually move toward its true intrinsic value.
But a good detective also needs hard evidence, right? That's where you look at the numbers, the quantitative factors like financial ratios. For instance, the price to earnings, or PE ratio, tells you if a stock seems expensive compared to its profits, and the debt to equity ratio shows you how much financial risk a company is taking on. These numbers give you that crucial, objective look at a company's health.
So, you've done your analysis, you've picked a stock? Fantastic! Now, how do you actually act on that decision? Well, there are two fundamentally different ways to get involved in the market. On one hand, you can buy shares directly. This means you own a small piece of the company. You might get paid dividends, and you need the full cash value to buy it. On the other hand, you can trade things like CFDs, or contracts for difference. With these, you're not owning anything. You're just speculating on which way the price will move. You can even profit if the price goes down. But, and this is a big but, it comes with a major catch.
Now, this number comes directly from the source material, and it's critically important to understand. It shows that with this particular provider, 71% of retail investor accounts lose money when trading CFDs. And that's mainly because of a very powerful tool used in this type of trading.
That tool is called leverage. Basically, leverage lets you control a really big financial position with only a small amount of your own money. It sounds great, but it's a classic double-edged sword. Yes, it magnifies your potential profits, but it also magnifies your potential losses just as much, which is exactly why it comes with such a high risk of losing money so quickly. And that brings us to our final and honestly probably the most important section of all. You can have the best analysis in the entire world, but if you can't control your own mindset, you're going to struggle. Your discipline is truly your greatest asset.
So let's bring it all home with these 4 pillars. First, always do your own research. Second, use a mix of both types of analysis to get the full picture. Third, make a plan and stick to it. That's how you avoid making emotional decisions. And finally, please don't put all your eggs in one basket. Always, always diversify your risk.
This quote right here gets to the heart of a huge trap for investors. That fear of missing out, FOMO, is one of the most destructive feelings you can have. When you hear a ton of hype around a stock, that should be your signal to slow down, not to jump in. Just take a breath and go back to your plan.
Let's end with this one crucial takeaway. A low stock price does not automatically mean it's a bargain. The real goal here isn't to find something cheap. It's to find a high-quality company that you believe the market is currently undervaluing. That right there is the art and the science of picking stocks.
So we've laid out the framework from understanding yourself and creating a plan to analyzing companies and managing your mindset. You now have the map. The only question left is what's your first step going to be?